Markets are unpredictable, and even the smartest investors can be caught off guard by sudden volatility, unexpected events, or economic shifts. Success is not about guessing the next trend, but designing a portfolio that remains strong and resilient no matter what happens. In this video, you will discover how to build a portfolio that thrives during uncertainty, balances risk and growth, and protects your wealth for the long term. Like and subscribe to learn practical strategies that prepare your investments for any market condition. 1. Understanding market uncertainty. Market uncertainty is the natural state of financial systems. Prices move due to economic cycles, geopolitical events, corporate performance, and investor psychology. While uncertainty can create opportunities, it also carries the risk of losses if portfolios are unprepared. Many investors fail because they assume past trends will continue or that short-term gains guarantee long-term security. Building a portfolio for uncertainty requires acknowledging that volatility is normal, inevitable, and sometimes extreme. 2. Diversification as a core principle. Diversification is the most fundamental tool for managing uncertainty. Spreading investments across multiple asset classes, sectors, geographies, and instruments reduces reliance on any single source of returns. Stocks, bonds, real estate, commodities, and cash equivalents all behave differently under varying market conditions. A sudden market drop may negatively affect one asset class but have minimal impact on others. Geographic diversification protects against regional economic shocks. Sector diversification reduces exposure to industry-specific risks. 3. Assessing risk tolerance. Every investor must define risk tolerance before building for uncertainty. Risk tolerance is not simply the ability to accept volatility. It is a combination of emotional resilience, financial capacity, time horizon, and personal goals. Overestimating tolerance leads to panic selling during downturns, while underestimating it limits growth opportunities. Portfolio construction should align allocations with this tolerance. 4. Asset allocation for resilience. Beyond diversification, asset allocation determines how capital is distributed among different classes to withstand uncertainty. Equities provide growth, bonds provide stability and income, cash offers liquidity, and alternative investments like commodities or REITs act as hedges against inflation or volatility. The allocation must balance potential returns with protection. Rebalancing ensures that allocations remain consistent with objectives. 5. Building a margin of safety. A portfolio designed for uncertainty incorporates a margin of safety, liquidity, cash reserves, and investments that provide downside protection. Liquidity allows investors to cover expenses or take advantage of opportunities without forced selling. Investments with stable income or low volatility cushion against losses during market swings. The margin of safety reduces stress, preserves capital, and allows rational decision-making. 6. Stress testing and scenario planning. Building for uncertainty requires actively testing portfolios against potential adverse scenarios. Historical crises, simulated market shocks, interest rate changes, inflation, and geopolitical events provide insight into potential vulnerabilities. Stress testing identifies weaknesses and helps allocate capital to strengthen areas at risk. This systematic approach ensures that a portfolio can survive extreme events without catastrophic loss. 7. Incorporating defensive assets. Defensive assets are critical for managing uncertainty. Bonds, Stable dividend-paying stocks, gold, and other tangible assets provide protection during market downturns. These assets often perform differently than growth equities when volatility spikes. They reduce portfolio swings and provide capital preservation without sacrificing long-term growth. A balance between growth and defense allows the portfolio to capture gains during uptrends while minimizing losses during declines. 8. The role of rebalancing. Even a well-designed portfolio drifts over time due to varying asset performance. Rebalancing is the process of returning allocations to their target proportions. This maintains the intended risk profile and ensures that no single asset dominates exposure. Rebalancing also naturally enforces a strategy of selling overperforming assets and buying underperforming ones, aligning with the principle of buying low and selling high. It reduces emotional decision-making and reinforces portfolio discipline. 9. Flexibility and adaptation. Market uncertainty requires flexibility. Economic shifts, policy changes, and global events can alter expected returns or risk dynamics. A portfolio must be adaptable, allowing allocation adjustments without sacrificing discipline. Flexibility does not mean frequent reactive changes, but thoughtful, rules-based modifications aligned with objectives and risk tolerance. Adaptive portfolios respond to new information, maintain diversification, and preserve defensive positioning. 10. Long-term perspective as a stabilizer. Finally, the most critical element in building for uncertainty is a long-term perspective. Markets fluctuate daily, weekly, and monthly, but wealth accumulates over years and decades. Understanding that uncertainty is temporary allows investors to maintain composure and stick to strategy. Patience transforms volatility from a threat into an opportunity. Combined with diversification, asset allocation, rebalancing, and defensive positioning, a long-term perspective stabilizes decisions and protects emotional resilience. Portfolios built for uncertainty are not immune to loss. Building a portfolio for market uncertainty proves that long-term success comes from preparation, structure, and discipline, not guessing or chasing trends. Resilient portfolios survive volatility, adapt to change, and continue progressing toward goals even in turbulent times. By incorporating diversification, allocation, rebalancing, and defensive measures, investors create systems that thrive under stress. Like and subscribe to continue learning strategies that protect wealth, reduce risk, and prepare your portfolio for any market condition.